Today, our topic is managing the taxes on your retirement income, presented by our guest speaker, Doug Ewing, Vice President of the Insights and Solutions Field Team at the Nationwide Retirement Institute. As a reminder, this session is being recorded and will be made available on the events page of our website once approved. This webinar is hosted by Lumena Financial Strategies, and your moderator today is Allison Fleming, President of Lumena Financial Strategies. Allison is a certified financial planner practitioner, and for those of you who may be joining us for the first time, I'll go ahead and introduce her. Allison's been a financial advisor since 1989 and serves clients in 29 states across the country. She holds a bachelor's degree in speech communication from Cal State Long Beach and believes that we must always adapt to the changing environment, remain current, and take advantage of opportunities to improve our clients' lives. Our local motto, be a long-term thinker, not a short-term worrier, serves as the cornerstone of her discussions. With that, I'll go ahead and hand it over to your host, Allison.
Thank you so much, Caress. Welcome to our webinar. Thank you so much for spending your Wednesday afternoon with us once again. And I'm so excited to have our guest speaker, Doug, back again to speak to our group. I know that he's been looking forward to this, and we've been looking forward to having him. He was actually our very first webinar speaker when we very first started them several years ago. So I just wanted to say thank you again for your time. Before I go ahead and have Doug begin his presentation, I'd like to make sure that everybody knows our team, because I do have some clients and friends on here who may not know everybody. So obviously you met me. The rest of the team, we have Miles Fleming, who is our Executive Vice President. He specializes in Medicare insurance. We also have Britt Stevens, who is our Vice President, and he is my counterpart in most of the client meetings. We have Peter Fink, who is our stock picker extraordinaire. Damian Feldman, who's our client experience manager. You'll speak to Damian usually when you call in. He's the first person that answers the phone. If you need an appointment, he's the man to talk to. We also have Terry Jocelyn, who's our executive assistant and administrative manager. She's helping make sure that everything is nice and tidy here in the office. And then there's Maddie Yola, who is up in our San Pedro location. She is working remotely and joined our team just over a year ago. We have Kaylee Kaufman, who's our client care coordinator, joining me in a lot of meetings, helping me take notes and helping me restructure some systems that we have here in the office, which is going really well, by the way. We have Justin Romine, who mainly supports Britt and is a student working remotely. We also have Lucy Adame, who is a student as well, working remotely, and she mostly supports Caress Vera, who is the voice from the sky and our creative director. She's the lady running the webinars. Most of you are very familiar with her voice and her work. So Caress, thank you so much for all the work that you're doing on these webinars. With that in mind, I'd like to go ahead and show you our disclosure slide, because we always have to be fully disclosed, and make sure that you read that very carefully. Now that you've had a minute, let's go ahead and get started with our webinar today. So Doug Ewing is my friend from Nationwide. We've gotten to know Doug over the years. He's presented several topics for us, and just has an amazing background. He travels the country, has a really interesting territory. He just told us that in addition to presenting to clients like you, he's also presented to many interesting groups. One that he listed most recently is gold miners. Who knew there was a group of gold miners? So anyway, it takes a lot of different strokes for different folks. So Doug, I'd like to just go ahead and invite you to introduce yourself a little bit more and go ahead and into your presentation.
All right. Well, thank you so much, Allison. I really appreciate the opportunity. So again, I'm Doug Ewing of the Nationwide Retirement Institute, and I cover the Western U.S., everything from Texas all the way to California. And I'm really excited you could be here today, because I love this topic. It's one of my favorites. What we are going to be focusing on today is managing the taxes on your retirement income. And we got a lot to cover, so we're going to dive right in. Now, the first thing we have to do here is I have my own disclaimer slide as well. And this is where I always take the opportunity to tell you a little bit about myself. So I am an attorney by background. I, like Allison, also hold a certified financial planner designation, but it is important for me to point out that while I am an attorney and I am a financial planner, I'm not your attorney and I'm not your financial planner. And all I mean by that is I'm not here today to give advice. And that's important because our topic today is taxes. And I am not here today to give tax or legal advice. And, Allison and her team, they don't give tax or legal advice either. However, here's what we will do today and what Allison's team can do, and that is provide an educational overview of how taxes work, not only as we get into retirement, but also as we save for retirement. Because when we have that educational overview, that's going to help us make decisions now that will benefit us later on when we get to retirement. Now, also, I know Caress addressed this, but we are absolutely open to questions, but we are going to hold the questions until the end of the presentation. So if a hand goes up or anything like that, I'm going to plow through the material first, and then we'll get to those at the end. So please understand, I'm not being rude. We're just going to hold those to the end for a couple of different reasons. But let's go ahead and get started, and we'll take a look at our agenda for the presentation today. We are going to start by taking a look at what we refer to as tax basics. There are a couple of different types of taxes that we want to be familiar with as they pertain to retirement, and we'll cover those. As we move through the middle of the presentation, we're going to be talking about the importance of diverse sources of retirement income. Now, that word diversification, I'm sure you've heard that one before, right? Diversification is a very important concept in terms of how we invest for retirement, right? We go into any given year, we don't know exactly what the market's going to do. We don't know which investments are going to do really well. We don't know which investments might lag behind. So what do? We don't put all of our eggs in one basket, right? We diversify. We buy large company stocks and small company stocks and international stocks, and we buy fixed income. And the reason we do that is that diversification is a risk management technique. That's why we do it. Well, when it comes to taxes, it's a very similar situation. We don't know exactly what the future holds with respect to taxes. We don't know if they're going to go up, they're going to come down, they're going to stay the same. So how can we prepare for that uncertainty? We can diversify. We can take the opportunity to save in different types of accounts that get different tax treatment. And if we can do that, then once we get into retirement, it's going to give us the ability to manage our taxes. And then finally, we'll suggest some next steps you can take to check on your own level of diversification when it comes to taxes. So let's start, though, by getting into tax basics. And when we think about tax basics, what we're referring to is that there are two primary types of taxes that we want to be familiar with as they pertain to retirement. Now, the first one we're going to discuss today, ordinary income tax, this is something that you will be dealing with every single year from now until the end, because ordinary income is a constant. The next type of taxes we'll be talking about are capital gains taxes, and capital gains are a little bit different. You may only run into a capital gains type of situation a handful of times in your whole life, but it's still important to understand how capital gains are taxed, because as we're going to see today, in certain situations, capital gains get preferential tax treatment compared to ordinary income. So we'll get into that in just a little bit, but let's start with ordinary income. And I think the easiest way to understand what we're referring to when we use that term ordinary income is to think about your wages from employment, right? We all kind of get that. We all sort of know the drill by now. What happens? We work all year, and then at the end of the year, after December 31st comes, we get a tax form from our employer, right? If we're an employee, we get a W-2. If we're an independent contractor, we might get a 1099. But either way, those tax forms basically do the same thing. They tell us, and they also tell the Internal Revenue Service, how much money we made for the year. And then what do we do with that information? Well, we will go ahead and we will report our gross income, right? Our income from all sources, we report that on our tax return. The next thing we do is we take any deductions that we are entitled to, and that gives us our taxable income. And once we know our taxable income, we can calculate the taxes that we owe. And at that point, it's all about withholding, right? If you've had too much money withheld from your paycheck, that's when you get a refund. If you haven't had enough withheld, you might have to write a little check to Uncle Sam by April 15th. But the reason I like to start there is that much of the income we're going to get in retirement is going to be taxed very similarly to our income from employment. Now, the first thing I'll mention is something that doesn't appear on the slide because it's not as common as it used to be, but pension income, right? If you are fortunate enough that when you retire, you get a pension from your employer, well, that pension is going to be taxed as ordinary income. Now, the next type of income I'm going to address is income from certain retirement accounts. And specifically, what I'm talking about here are tax-deferred retirement accounts. Tax-deferred retirement accounts have been probably the most popular way people have been saving for retirement, going all the way back to the 1970s with the introduction of the individual retirement account and the subsequent introduction of the 401k. This is how a lot of people save for retirement. And I'll just review really quickly. How does a tax-deferred retirement account work? Well, what we do in a tax-deferred retirement account is we are making contributions to that account on a pre-tax basis. So if it's an IRA contribution, we get to deduct that on our taxes. If we are contributing to something like a 401k, those contributions are taken out and deposited into that retirement account before they are taxed. So when you have money in a tax-deferred retirement account, what you should always be remembering is that money has never been taxed. And when we have money in a tax-deferred retirement account, the goal should always be to get that money out at the lowest possible tax rate. And we're going to talk about how you can do that in a little bit. Now, tax deferral is great. I mean, don't get me wrong. It is a great way to save for retirement because ideally what we're doing is we're avoiding paying taxes during our working years when our tax rates are likely to be higher, and we're shifting that tax responsibility into retirement when ideally our taxable income is going to be a little bit lower. So tax deferral is great, but here's one thing to remember. Tax deferral does not last forever. Eventually, we will get to a point where the IRS is going to tell us, hey, now you have to start pulling money out of your tax-deferred retirement account. These are called required minimum distributions. And what's interesting is over the last several years, Congress has been busy changing the rules about required minimum distributions. So it wasn't that long ago, just a few years ago, when you had to take your first required minimum distribution in the year that you turned 70 and a half years old. Well, a few years ago, in a big piece of legislation called the Secure Act, Congress said, well, we're going to push that back to 72. And then in a subsequent piece of legislation called the Secure Act 2.0, Congress said, you know what, we're going to push that back even further, and we're going to push it back to 73. But for many of us born in 1960 or later, we won't have to take our first required minimum distribution until the year we turn 75. Now, with Congress pushing those RMDs back, a lot of people might think, well, geez, I guess what they're telling us is we should wait to take these RMDs, right? We should wait as long as we can, right? Not necessarily. One of the things we're going to see today is that you may have opportunities to pull money out of your tax deferred accounts much earlier in retirement, not because you have to, but because you will have the opportunity to take advantage of very favorable tax rates. So we will get into that very shortly. Now, another way that some of us will save for retirement is in a good old-fashioned savings account at the bank. right? Or maybe it's a money market account or a CD or something like that. Well, the thing to remember about those accounts is the interest that we make on those accounts is taxable, and it is also considered ordinary income. Didn't used to be a big deal a few years ago when banks weren't paying a lot of interest, but now you can make a little bit of interest on your cash. But just remember, if you do, that is taxable and you will have to pay taxes on that as ordinary income. We'll talk about Social Security a little bit later in the presentation. The good news here is that you don't have to pay social taxes on all of your Social Security. But to the extent you do, again, it's ordinary income. So as you can see, a lot of our retirement income is going to be taxed as ordinary income. Now, let me touch on capital gains just for a second here. And as I said before, capital gains are something you may not run into nearly as often as you do ordinary income. And for the average person, I'd say there are probably two areas where you are likely to run into a capital gains situation. The first is if you are investing outside of a retirement account. We call this a non-qualified brokerage account or just a regular old brokerage account. And let me give you a quick example of how that would work. So let's say that I had some extra money and it was long-term money. It's for the future. And it's just sitting in a savings account. It's money I've already paid taxes on, sitting in a savings account. And I decided to invest it. And so I call Allison and I say, Allison, can I open up just a brokerage account? And we get that set up and I deposit some money in there. And after talking to Allison, we're building a portfolio and we're looking at our best investment options. And I think, and I ask, well, geez, I'm looking at my iPhone here and I'm thinking Apple, right? Apple's one of the most valuable companies in the world. I'm a big Apple, fan. Let's buy some Apple stock. And so we look at Apple and Apple's trading at $100 a share. So I buy some. A couple of years go by, talking to Allison, and Allison says, hey, look, Apple's gone from $100 a share all the way up to $120 a share. So we decide to sell it. Well, that $20 a share I made on that Apple stock, that's a capital gain. And I will have to pay taxes on that when I sell that stock. Now, some people don't invest much outside of their retirement accounts, and we'll talk about why you might want to think about doing that in a little bit. But I'll tell you one investment that many of us do make during our lifetimes that can also generate a capital gain, and that's real estate. And so let me give you a little example of how real estate can lead to a capital gain. So let's say I've got some extra money and you know what? I'm rather than invest in stocks, here's what I'm going to do. Been watching a lot of HGTV lately. And what do they like to do on HGTV? They like to flip houses, right? So let's say that I go out and I decide I'm going to do that. I'm going to buy a little house. I'm going to fix it up. I'm going to sell it. Hopefully, I'm going to make a profit. So I find a little house for, let's say, $500,000 and I buy it. And then I spend $100,000 fixing it up. That's what they do. And so I've now invested $600,000 in that house, but I did a really good job. It looks fantastic. So after I'm done, I'm able to put that house on the market and I can get $800,000 for that house. So I invested $6, I'm selling it for $8. I just made a $200,000 capital gain. But again, as soon as I sell that house, I'm going to have to pay taxes on that. Now, here's one thing to know, though. There is an exception to that rule when it comes to real estate, and that exception is called your personal residence. That is IRS lingo for the house, your primary residence, I should say. That is IRS lingo for the house that you actually live in. And I always like to talk about this because let's face it, for a lot of people, when they retire or when they're getting ready to retire, what are they going to do? Going to sell the house, right? Maybe, your kids are grown, they're gone, the house is bigger than you need now, so you're going to downsize, or you're going to move to a different part of the country. When you sell your personal residence, though, now technically that will also generate a capital gain, But here's what's cool. And you can see it's at the very bottom of the slide in the fine print. When you sell your primary residence, you are allowed to exempt a certain amount of capital gains from taxes. And if you're a married couple filing a joint return, you can exempt up to $500,000 of gains. If you're a single person, you can exempt up to $250,000 of gains. So again, a little example. I use a lot of examples. I hope they help. So let's say 20 years ago, my spouse and I, we went out, we bought our house. We paid $400,000 for our house. We've lived there for 20 years. Now we're going to sell it, and we're able to sell it for $800,000. Well, again, technically that's a $400,000 capital gain. But remember, my spouse, we can exempt up to $500,000 of capital gains when we sell our primary residence. So in that situation, that $400,000 that we made on our house, completely tax-free, which is really nice. Now, what if I was really lucky and I was able to sell my house for $1 million? Well, that would be a $600,000 gain. I can exempt $500,000, so I would still have to pay taxes on $100,000. All right. So here's the thing. The examples I just gave you are very simple examples. There's a lot that goes into determining the exact amount of a gain when you sell a piece of property. And if you have issues, as with any of the tax things we're going to discuss today, if you have a situation where you actually need to know, for example, what type of gain you'd be looking at, it's very important to talk to a tax professional, because only tax professionals can give you tax advice, not us. But I do hope at least those examples helped you to understand what the issues are. Now, next thing we're going to do is we're going to take a look at the 2025 ordinary income tax brackets. And this is going to show us how our income is taxed each year. So here in the United States, we have what is commonly referred to as a progressive or a graduated income tax system. And here's how I like to explain that. Each year, we start on January 1st with zero income, right? We haven't made any money for the year yet. And as we go through the year, we start getting paid. And so as you're getting paid every pay period, think of it this way. Think of you're building a pile of money as we go through the year. Well, each layer of that pile gets a different tax rate. And that's what tax brackets are all about. So remember, we talked about how we do our taxes. The first thing we do is we report all of our income, our gross income, and then we take our deductions. And this is where I want to introduce the concept of the standard deduction. Now, if I want to, I can itemize my deductions. And some of the more common itemized deductions that people take are things like home mortgage interest, state and local taxes. We get to deduct those things. But here's what's interesting. The tax rates that you see on this slide were introduced back in 2017 in a big piece of legislation called the Tax Cuts and Jobs Act. That is scheduled to expire at the end of this year. Long story short, I think it will be extended. But we don't know for sure yet. But so what they were doing when Congress passed the Tax Cuts and Jobs Act, some of you may remember this. Obviously, there was a lot of debate going on. It's big tax policy. And what the proponents of the bill in Congress were saying was, this is all about simplifying taxes, right? There were people running around Congress holding postcards saying, you're going to be able to do your tax return on a postcard. That's how easy we're going to make it. Well, that hasn't happened, but they did do a couple of things that did simplify taxes. And one of those things was they introduced a new, much larger standard deduction. So for this year, 2025, we all start with a standard deduction of $15,000. And that's pretty generous. And the reason I say that, I'm not making a subjective judgment on this. The reason I say that standard deduction is generous is because according to the IRS, 90% of taxpayers, right around 90% of taxpayers, are simply taking the standard deduction when they file. So if your itemized deductions are more than $15,000, you can still take those, but most people are just taking the standard deduction, and that does make things a little bit easier. And the way I like to think about that standard deduction is it's almost like starting every year with a 0% bracket, because that standard deduction essentially cancels out your first $15,000 of income for the year. Now, a couple of things. There are some other tax statuses. One of them is called head of household, and that's if you're a single filer with dependents. And if you are a head of household, you get a bigger standard deduction. I believe it's around $22,000. So if you're a single person and you've got, kids, you're going to get an even bigger standard deduction. But what you see on the slide is the standard deduction for people over the age of 65. So here's how that works. If you are a single filer, in the year you turn 65, you get an extra $2,000 added to your standard deduction. That brings it up to the $17,000 that you see on the slide. If you're a married couple, as each one of you hits age 65, you get an extra $1,600 added to your standard deduction. So if you're a married couple and you're both over the age of 65, your standard deduction is actually $33,200. Think about that for a second. That's a lot of income, and that is going to be completely offset by that standard deduction. That's why I say it's almost like a 0% bracket to start every year. Now, we're going to show you on the next slide exactly how these brackets work when we're calculating a tax bill. But two quick things before we move on. The first thing I want you to do is I want you to figure out what's your tax bracket. So very easy to do. So for example, let's say I'm not 65 yet. Here's what I would do. If I was a single person, I just think, what is my gross income going to be this year? And then I just subtract $15,000. So let's say I'm a single person. I'm going to make $100,000 this year. I subtract 15,000. That means my taxable income is going to come in at 85,000. I look up, where is 85 on this chart? Aha, I'm in the 22% bracket. Now, that doesn't mean I pay 22% on all of my income. It just means I'm paying 22% on my next dollar of income. We'll see exactly how that works on the next slide. If you're a married couple, think, okay, my spouse and I together. So let's say we're going to make $250,000. We combine our standard deductions. That comes to $30,000. We deduct that. That means our taxable income would be $220,000. We look on the chart and we say, okay, I'm in the 24% bracket. Now, I've got a new presentation that I'm in the process of putting together. And here's what I did in that presentation. I color-coded these tax brackets. And I'll tell you what I did. For the 10 and the 12% bracket, I color-coded those in green because I would argue those are pretty favorable tax rates. The 22 and the 24% brackets, I color-coded those in yellow. A little bit of a judgment call there, but those 32, 35, 37% brackets, we code those in red. You do not want to be paying taxes at 32 or 35 or 37%. Oh yeah, one last thing. Look at the difference between the married filing jointly brackets and the single filer brackets. As you can see, they are twice as wide. What does that mean? It means if you go into retirement and you are married, you get the benefit of those married filing jointly tax brackets. And that can actually be an opportunity to get money out of your tax deferred accounts at a relatively low tax rate. And that's something that you might want to consider. We'll come back and talk more about that in a little bit. But I like this next slide because this shows you exactly what I meant when I said our income is taxed in layers. So very simple example. Let's say I'm a single guy and I'm going to have a lot of income this year. I'm anticipating that my gross income is going to be about $150,000. So the taxable part of my Social Security, maybe I get a small pension, maybe I take a couple of retirement plan distributions, I get to $150,000. So let's see how my tax bill is calculated. So the first thing I'm going to do is, because I'm 65, I'm going to take my standard deduction of $17,000. So we subtract that from my gross income, and that means that my taxable income is $133,000. So how is that going to be taxed? Well, let's take a look at our brackets. And this is a great example of what I said when I said our income is taxed in layers. My first layer of taxable income from 0 to $11,925, that's taxed at 10%. So that's going to add $1,193 to my tax bill. The next layer of income, which is just about 37, I think it's 36.5 thousand dollars, that is going to be taxed at 12%. That's going to add $4,386 to my tax bill. Now, let me just stop right there for a second, because this is a very important breakpoint. Because once I get to the end of the 12% bracket, what's that next bracket? 22%. So if I stopped at the end of the 12% bracket, I've taken about $65,000 of income, and I have paid just over, not quite $5,500 in taxes. So if I were to average that out to come up with something called my effective or my average tax rate, it's about 8.6%. And I would argue that if you can get money out of your tax deferred account paying an average tax rate of 8.6%, that's a pretty good opportunity. That's a relatively low tax rate by historical standards. But here's the problem in my example. I'm not done paying taxes yet. So what we see as we get into that 22% bracket, look at what that does to my tax bill. I'm going to have just about just under $55,000 taxed at 22%. That adds $11,743 to my tax bill. Then I bump into the 24% bracket. And I don't even get all the way through the 24% bracket. I get about a third of the way into the 24% bracket. And yet that adds another $7,000 to my tax bill. So by the time I'm done, I'm paying over $24,000 in taxes. And again, if we were to average that out, look what's happened to my effective tax rate. It's almost doubled all the way up to 16.3%. So as we look at this, I think some of you are probably thinking, well, it'd be great if I could go ahead and take advantage of my standard deduction in those lower brackets, but avoid paying taxes at those higher brackets. And that would be great. The question is, how do you do that? And this brings me to tax diversification. If, when I get into retirement, I have different types of accounts available, taxable accounts, tax deferred accounts, and tax exempt accounts, that can give me the flexibility to manage my tax bill. So let's get into each one of these accounts and we'll explain what we're talking about and how they work. So when we talk about taxable accounts, these are very simply accounts that are not tax deferred. And I've already given a couple of examples. Your savings account at the bank. When your savings account pays you interest, when do you have to pay the taxes on that interest? In the year that you receive it. If you have a brokerage account and you sell that Apple stock, when do you pay taxes on that capital gain? In the year that you sold the stock. So they're just not tax deferred. And the one thing to be aware of with these taxable accounts is this is where you might run into a capital gains situation. So if you take a capital gain, the question is, how will that capital gain be taxed? And the answer depends on how long you owned that particular investment. If you own an investment for 1 year or less and you sell it, well, any gain that you made on that investment is considered a short-term capital gain. And short-term capital gains don't give you any sort of tax advantage. They're taxed as ordinary income. But if you own an investment for more than a year and then you sell it, well, now any gain that you've made on that investment is considered a long-term capital gain. And as you can see on the chart on the bottom half of the slide, long-term capital gains get preferential tax treatment compared to ordinary income. So as you can see, there are only 3 tax brackets for long-term capital gains, 0%, 15%, and 20%. Well, each one of those brackets is better than the corresponding tax rate on ordinary income. And this can give you an advantage in retirement. So let me give you another quick example of how this might work. So let's say, again, I'm a single guy and I'm over 65 and it's November. And because I'm kind of a geek and I pay attention to this stuff, I know that my taxable income's at about $50,000 for the year so far. Now, here's the problem. It's only November. I need a little bit more money to get me through the rest of the year. And let's say I have a choice. I can pull money out of a tax-deferred retirement account, or I can sell my Apple stock and take a capital gain. Which is better? Well, if I take a distribution from a tax-deferred account, I'm in the 22% bracket for ordinary income. So I'll pay 22% on that distribution. But what if I sell my Apple stock instead? Well, if it's a long-term capital gain, I'll only pay 15% on that gain. 15% is better than 22%, obviously, but you know what? It's actually even better than that. Because when I sell my Apple stock, what am I actually paying taxes on? Just the gain. The $100 a share that I invested in the Apple stock, that's my cost basis. And I get that money back without any tax ramifications at all. So just be aware that long-term capital gains can be a nice alternative to ordinary income. But of course, you got to have the taxable account first. Now, the next type of account is a tax-deferred account. And here's the thing. For most of us, this is already where we have a lot of our investments because of the success of the 401k. You know, most of us, as we've been saving through our working years, we've been taking advantage of tax deferral. And so if we look at the average person going into retirement, their biggest bucket, right, if we're talking about 3 different buckets of money, their biggest bucket is going to be the tax deferred bucket. So usually we're not too concerned about growing, putting more money into that tax deferred bucket. I will tell you, though, where many people are lacking, and it's in this last bucket. Tax exempt income. And as you can see on the slide, there's lots of ways you can get tax exempt income in retirement. Some of you might invest in municipal bonds, which pay interest that is generally free from state, local, and federal taxes, depending on where the bonds are issued. And that's a possibility. Another one that a lot of people don't think about is if you have permanent life insurance. This is life insurance that grows cash value. So think whole life, universal life, variable life, a lot of different types of permanent life insurance that actually build cash value inside of the policy. Well, that cash value can be accessed very tax efficiently, in some cases, tax-free. Health savings accounts, that's another one. A lot of people now, when they get their health insurance through work, they'll get a high deductible health plan, which gives them the opportunity to contribute to a health savings account. Health savings accounts are great. They're actually triple tax-free. The money goes in pre-tax, it grows tax deferred, but when you pull money out of a health savings account, as long as you're using it for a qualified medical expense, which is a very broad category of medical expenses, the money comes out completely tax-free. But the one I really want to focus on here today are Roth accounts, because Roth accounts, we know from the data, Roth accounts are underutilized. And I think a lot of people would benefit from having some money in a Roth account when they retire. So if you recall, the first Roth account to come on the scene was a Roth IRA, individual retirement account. And this is very similar to a traditional individual retirement account, except with a Roth account, you're not making a pre-tax contribution, you're making an after-tax contribution. And what you get in exchange for that is the money in a Roth IRA grows tax deferred, but here's the kicker. When you pull money out of a Roth account in retirement, it generally comes out income tax free. That's the deal. Pay taxes up front, get tax-free growth later on. Now, Roth IRAs have been reasonably successful, but there are always a couple of big hurdles to getting money into a Roth IRA. For one thing, there are income restrictions. If you make too much money, you don't get to contribute to a Roth IRA. For a single filer, I believe it's around $140,000 that you get phased out of your ability to contribute to a Roth. And for a married couple filing a joint return, it's around $240,000. Once you get above those levels of income, you're not allowed to contribute to a Roth IRA. And even if you can, the contribution limits are good. For 2025, they're at $7,000 a person. If you're age 50 or older, you can get an extra $1,000 in there. But good, but not great. We'll just say that. And this brings me to Roth 401k. So when you have a qualified retirement plan available to you at work, whether it's a 401k, if you're an educator or work in a hospital, you might have a 403b. If you work for the government, you may have a 457b. But when these plans offer a designated Roth account, that's a terrific way to get money into a Roth because a couple of things. First of all, no income restrictions. So anybody can contribute to a designated Roth account. And then secondly, the contribution limits are dramatically better, right? For this year, you can get up to $23,500 into your designated Roth account if you choose to. And then the catch-up contribution for people age 50 or older is $7,500. So theoretically, you could get as much as $31,000 into a Roth 401k. Now, of course, if you do that, that means you're not making a tax-deferred contribution because those contribution limits are cumulative. And the reality is you can mix up your contributions between traditional and Roth however you want. So here's a little exercise. Remember I asked you to figure out your tax bracket? Here's why. Because before you go running out and start contributing all of your salary deferral into a Roth account, you got to think about the tax implications. So here's another quick example. Let's say that my goal for the year is to get $10,000 into my retirement account. And as I said, you can mix and match however you want. But let's, for the sake of this example, let's say I'm either going to do traditional or I'm going to do Roth. And you want to know which is better. Well, first question I would ask you in response to that would be, well, what's your tax bracket? Let's say you come back to me and you say, well, I'm in the 22% bracket. Well, here's what you need to think about. If you're in the 22% bracket and you make a pre-tax contribution of $10,000 to your traditional 401k, guess what? You just saved $2,200 on your taxes because that's $10,000 that will not be taxed at 22%. Now, if you were to contribute that same $10,000 to your Roth account, you would have to pay $2,200 in taxes on that contribution now in order to get it in there. So again, which is better? Well, if you press me and say, okay, I still want to know which one's better. Well, here I would ask you another question, and that is this. Let's say that you contributed $10,000 to the pre-tax account, and as a result of that, you saved $2,200 on your taxes. Here's my question. What are you doing with that money? If you call Allison and say, Allison, I want to open up a traditional brokerage account. I want to deposit that $2,200 in there. I want you to invest it. We're going to save that money for retirement. I would say, good on you. That is a wonderful strategy. And that's how you maximize the value of that tax savings. But you know what? That's not what most people do. Most people, when they get that $2,200 tax break, you know what happens to that money? They spend it, right? It becomes part of your disposable income. You spend it and it's gone. If that's what's happening, that is when I would suggest you might want to think about the Roth account. Because when you contribute to the Roth account, yeah, you're still spending that $2,200, but what are you spending it on? You're spending it on taxes now, and in exchange for that, you are buying Uncle Sam out of any future growth in that account. So again, it's a complicated decision. It's something you might want to talk with your, financial professional or a tax professional about before you make that decision. But I would argue, even if you just contribute a little bit of money every year to your Roth account, having that tax-free bucket when you retire can be helpful. I'll show you an example of that in just a minute. All right, let's talk really quickly about Social Security. As I mentioned before, the good news with Social Security is you don't have to pay taxes on all of your Social Security. Now, what we're looking at on this slide is a very complicated calculation that tells us how much of your Social Security you will end up paying taxes on. Rather than go through this calculation, let's just cut to the worst case scenario. Your worst case scenario for Social Security is that you will pay taxes on 85% of your annual Social Security benefit. At least 15% of your annual Social Security benefit is federal income tax free. And the reality is, some people pay less than 85 taxes on less than 85% of their Social Security. It has to do with how much other income you have. If you have a lot of other income, you're going to pay taxes on 85% of your Social Security. If you don't have a lot of other income, you may pay taxes on less than 85% of your Social Security. So I think we have a wonderful presentation on Social Security. We can talk about how to maximize your Social Security. And one reason you might want to do that is it's a very tax efficient stream of income. By the way, if you live in a state that has a state income tax, like say, for example, California, be aware that many of these states exempt Social Security income from state income taxes. And that makes it even more tax efficient. So Social Security is a really important part of a tax efficient retirement income plan. Okay, so covered a lot, getting close to the end of our time here. So let's try to bring this all together with a little example. So hopefully what we're doing is we are building some tax diversification as we save for retirement. We've got taxable account, we got our tax deferred account, and hopefully maybe we're building up a little bit of money in a tax exempt account. Assuming we do that, the next question is, well, how do we use this to our benefit in retirement? And to illustrate this point, I'm going to show you a very simple example. So here's what we're looking at. We're going to look at two couples, and both of our couples are going to be faced with the exact same scenario. Normally, they take about $100,000 a year of gross income. But this year, each of our couples is going to have a couple of additional expenses. The first is they're going to take their grandchildren on a trip to the Grand Canyon. You can see they get the RV rented. They're ready to go. I don't know how you spend $10,000 at the Grand Canyon, but that's going to be a really nice vacation. The next thing they have is they're going to have to do some home improvements, and that's also going to be another $10,000. So each of our couples needs an extra $20,000 this year. So let's see how they do. We're going to start on the left with couple number one. And I always like to say couple number one, they must have sat in on couple number one, actually, couple number one, this is a very common scenario. We're going to say that couple number one has all of their retirement savings in tax deferred retirement accounts. So couple number one, when they have to pull money out of their 401k, that adds to their gross income. So now their gross income's at $120,000. They're going to take their standard deduction of $33,200. That means their taxable income is going to be about $86,800. So how is that taxed? Well, the good news here is that they are still in relatively low brackets. They're going to fill up their 10% bracket, and they're going to almost fill up their 12% bracket. And as you can see, their tax bill at the end of the year is going to be about $9,939. Couple number two, on the other hand, I always like to say they must have sat in on this workshop, because couple number two has a little bit of tax diversification. They have money in a Roth account. They also have money in savings at the bank. So here's what couple number two is going to do. For their vacation, couple number two is going to tap their Roth account. And I love this use of a Roth. Roth accounts are perfect for some of those one-off fun things you want to do in retirement, like take a vacation. You pull that money out. It does not add to your gross income. It's a tax-free distribution. That money can, 100% of that $10,000 can go toward their vacation. Now, for their home improvement, what are they going to do? They're going to tap their savings. And, this is a good example of how something as simple as a savings account can help you manage your tax bill in retirement. Because if you take a withdrawal from your savings account, I mean, yeah, you're paying taxes on the interest every year. But when you take a withdrawal, does that add to your tax bill for the year? No. So couple number two is able to keep their gross income at $100,000. They take their standard deduction. That brings their taxable income down to $66,800. And long story short, what have they done? They have just reduced their exposure to the 12% bracket by $20,000. And what does that mean? They just saved $2,400 on their tax bill, which is nice. Now, here's the thing, full disclosure. If we're going to do an apples to apples comparison, what do we need to acknowledge? We need to acknowledge that couple number two, as they were contributing to their Roth account, they were paying more in taxes. When you contribute to a Roth account, you are voluntarily agreeing to pay more in taxes than if you contributed to a tax-deferred account. Here's the way I look at that, though, because I contribute to a Roth account. I send some of my money into that Roth account every pay period. And the reason I do it is this. I'm working now. I have income. And because of that, I'm a little bit more comfortable paying taxes now than I will be in retirement. Because here's the thing, when I go into retirement, like many of you, I'm going to have a limited amount of money. And that money has to last me all the way through my retirement. So the last thing I want to be doing as a retired guy is writing big checks to the IRS, right? Because where's that money going to come from? It's going to come from my retirement savings. And that means I might have to draw it down a little bit more aggressively than I want to cover that tax liability. And that just makes me uncomfortable. And so that's why I do it. It's not going to work for everybody. If you're in a very high tax bracket, the better strategy might be max out your tax deferred contributions, take that tax savings, but make sure you save it and invest it. But if you are so inclined, you can contribute a little bit to your Roth account. And if you do, this is how you can use it in retirement to manage your tax bill. Having tax diversification gives you the flexibility to be able to say, you know what? I don't want to pay taxes at 22% or 24%, because keep in mind, when we look at this example, these are the very lowest tax brackets. If you're going to have significantly more income than that in retirement, and some people will, then your tax savings by tapping a Roth would be even greater than what we show in this example. So certainly something to be thinking about. Okay, so I guess just to kind of wrap up, next steps, again, I'm not here to give tax and legal advice. Allison and her team don't give tax and legal advice. However, what you can do is sit down with a financial professional, and you can start looking at your overall tax picture or your overall savings picture. And what I think is a great exercise is start looking at your retirement accounts and start categorizing them in terms of which bucket they fit into: taxable accounts, tax deferred accounts, and tax-free accounts. And building diversification can be a nice way to be able to manage your tax bill later on. So hopefully we've got you thinking about that. It's a personal decision. Whether it makes sense for you is going to depend on your individual circumstances. But I hope this concept is something that will kind of stick with you guys, and you'll be thinking about this as you save for retirement and then as you transition into retirement. And so with all that, here's what I'm going to do. I'm going to turn it up. There's Koresh. She's right on time. We're going to, at this point, let me turn it back over to Allison, but we can entertain a few questions if you guys have any.
Yes, we will take some questions. I wanted to mention to everybody that we have a new tool as part of my financial planning package that is specifically a tax analysis program called Holistaplan. And whether it's part of a financial plan in total, or whether we just look at different what if scenarios, it's not tax preparation. We don't do that. We don't give advice, but it basically takes a tax return, loads it into a program, and then allows us to run what ifs and change the numbers, and it just does the math for us. And so a lot of clients have been taking advantage of that. That's a new tool that we have. Just wanted to offer that up in support of Doug's idea.
Well, this concludes our webinar. Thank you to everyone who attended. And for those of you who are listening to this recording after, if you have any questions on the topic, please feel free to reach out to us by phone or by email. You can contact us at team@lumenafinancial.com. The next webinar in our monthly webinar series will be held on Wednesday, March 26th, and that will also be at 4:00 p.m. And we'll be hearing from Douglas Lewis, who is the Regional Advisory Consultant with Columbia Threadneedle, and he'll be speaking on the topic, 7 Things No One Tells You About Retirement. So mark your calendars and please join us on March 26th for that webinar. We hope to see you there. See you next time.